Welcome back to The Explainer. I am super excited to have you here today because we're going to unpack a really fascinating real-world investor journey looking at DoorDash, ticker symbol DASH. Let me walk you through my exact timeline with this one. So the very first time I started doing a deep dive analysis on DoorDash was back in early May of this year. The stock was sitting right around the $140 mark. Now, I was totally convinced they had a brilliant business model, but I hesitated. Why? Because I was genuinely worried about the risks of AI disruption. And honestly, that hesitation caused me to completely miss the bottom. But by early July, my thesis finally clarified, and I took a small allocation in my investment account at $180 a share. Fast forward to today, and it's trading around $217 following an absolute monster Q2 earnings report. So how exactly did we get here? And more importantly, where is it heading next? Let's get into it.
Okay, let's dive into our 5-step roadmap for today. Number 1, the AI disruption dilemma. 2, business moats and market dominance. 3, decoding Q2 financial performance. 4, SWOT and intrinsic valuation. And 5, we'll wrap up with a technical trading tactical plan.
Section 1, the AI disruption dilemma. Navigating those initial fears and trying to nail down market timing.
You know, overanalyzing a macro trend can absolutely wreck your market timing. Back in May, looking at that $140 level, the fear in the market was palpable. Everyone was asking, is generative AI going to completely upend the app-based delivery model? And that fear literally kept me on the sidelines. But as more data rolled in, it became crystal clear that the physical realities of logistics actually offer a massive layer of protection. So by early July, I made that entry at $180 with a lot more confidence. And as you can see, the stock has since rallied up to roughly $217. And this brilliantly illustrates the counter perspective that changed my entire thesis. Think about it. Generative AI is fantastic at displacing digital-first software, right? But it cannot physically hand a burrito to a customer. DoorDash's core, unbeatable asset is physical last-mile fulfillment. So rather than disrupting them, AI actually supercharges their operations. They're using it for incredibly complex routing, smarter dispatching to cut down delivery times, and even predicting demand for grocery orders. Plus, they are actively testing these autonomous dot robots in select markets like Phoenix right now, aiming to handle a high single-digit percentage of order volume by the end of the year. So AI is actually a serious tailwind here, definitely not a headwind. Moving on to Section 2, business moats and market dominance. Let's look at the sheer power of the last-mile advantage.
To really understand why DoorDash is so incredibly resilient, you've got to look at their 3-sided network flywheel. This ecosystem connects merchants, consumers, and Dashers all together. They generate revenue through merchant commissions, consumer service fees, and of course, subscriptions. But the absolute magic word here is density. Logistics density. As more merchants jump on the platform, they draw in more consumers, which naturally attracts more Dashers. This density drives their unit fulfillment costs down, creating this highly efficient, looping ecosystem that competitors find almost impossibly expensive to crack into. DoorDash absolutely dominates the landscape with roughly 67% of the US food delivery market. I mean, that is huge. But what's crucial to understand isn't just how much they dominate, but where. Their leadership is heavily concentrated in suburban markets. This suburban stronghold creates a profitability moat that urban concentrated rivals are just struggling to replicate. Why? Because out in the suburbs, order sizes tend to be significantly larger and driving routes are much more predictable, which directly fuels much better margins.
But they don't just rely on geography for their moat, they rely on incredible loyalty. DashPass is an absolute powerhouse for keeping customers locked in. Get this, in Q2, DashPass subscribers actually accounted for approximately 75% of all orders in U.S. grocery and retail categories. 75%. That is a massive lock-in mechanism. It drives up order frequency, and it skyrockets the lifetime value of every single consumer on their platform.
Let's move to Section 3 and see how this builds into the actual numbers. Decoding Q2 financial performance, the 2026 reality check.
Now, what's really interesting here is the stark contrast between the top and bottom lines. Marketplace gross order value and revenue both surged an incredibly impressive 36% year over year. Revenue hit $4.45 billion. Adjusted EBITDA was also up 40%. But then, look at the GAAP net income. It actually dropped 30% to $200 million. So what happened? Well, it was heavily weighed down by the temporary integration costs of Deliveroo, a massive 52% spike in R&D, and higher stock-based compensation.
But if you want to know the absolute truth about any company's financial health, you look straight at the cash. Specifically here, $2.10 billion. That is DoorDash's trailing 12-month free cash flow,
We are talking about a massive 75% plus increase. This one number cuts right through all that accounting noise, the stock-based compensation, the integration costs, to show you the raw, underlying cash-generating power of this business.
And we have to give credit to founder and CEO Tony Xu, because he is putting that cash to work with extreme discipline. DoorDash has a $5 billion share buyback authorization in place, and they still have $3.95 billion remaining. So they are aggressively reinvesting in adjacent verticals like retail and grocery, but at the exact same time, they're using that stellar cash conversion to consistently scoop up and repurchase shares during any market pullbacks.
All right, Section 4, SWOT and intrinsic valuation. Let's weigh the real long-term potential here.
If we objectively break this down, the strengths are undeniable, right? That dominant U.S. suburban market share and that $2.1 billion in free cash flow. But we do have to address the elephant in the room, heavy gap dilution through stock-based compensation. They're expecting between $1.2 and $1.3 billion this year, which is a heavy burden on the stock. On the upside, there are massive opportunities to scale internationally through efficiencies from their Wolt and Deliveroo integrations, plus they're expanding their advertising revenue. However, we can't ignore the threats. They face persistent regulatory pressures and new minimum wage mandates for Dashers in major hubs like New York City and Seattle.
When we actually look at the valuation, DoorDash is sitting at a market cap of around $94 billion. Now, at first glance, the GAAP PE ratio looks wildly elevated at 113x. But remember, that's heavily skewed by the R&D and stock-based compensation we just talked about. If you shift your focus to the forward price to free cash flow, it's trading at a much more reasonable 45x. Given their 20% top-line growth and those expanding margins, a fair intrinsic value estimate actually ranges between $230 and $250 a share. So this really confirms that entering at $180 offered a fantastic margin of safety, and honestly, even at today's $217 price tag, it remains a premier growth asset.
Okay, finally, Section 5, Technical Trading Tactical Plan. Let's map out the short-term setup and the key levels you need to watch.
So the crucial point is how we act on this data right now. The stock has shown incredibly strong bullish momentum, breaking out above its 50-day moving average right after that Q2 earnings gap up. Right now, the 14-day RSI is floating around 66. That means it's definitely approaching overbought territory, suggesting we might see a little bit of near-term consolidation. Immediate resistance sits right between $220 and $225, with a major consensus target of $250 plus. Now, if it does pull back, your primary support sits at the $200 psychological level, with secondary support right back down in our initial entry zone of 180 to 185.
So here is a highly actionable, step-by-step tactical playbook. Step 1. Simply hold the current position. The risk-reward ratio from that $180 entry is just excellent right now. Step 2. If you happen to be executing a short-term swing trade, you might want to consider trimming partial profits as it approaches that $225 to $223 resistance zone. And Step 3, place a trailing stop just below $198. This perfectly protects your gains in case we see a broader market pullback while still leaving plenty of breathing room for the long-term thesis to play out.
And that brings us to my final question for you today. Looking at all this data, the deep competitive moats, the massive cash flow, weighed against that high stock-based compensation, will you hold Dash as a core long-term compounder in your portfolio, or are you going to use these technical levels to strategically trade the short-term swings? I really hope this explainer gave you a clear, structured framework to answer that for yourself. Thanks so much for joining me today, and keep learning.